While we're waiting for a few more people to sign in, I will just kind of get started with some introductions, kind of lay out the ground rules. I know many, we appreciate all of our clients who are able to listen in on these events, and we're going to conduct this one very similar to in the past. Today we've got two special speakers with us. We've got Matthew Estes, CIMA, which is Certified Investment Management Analyst, and he also serves as Managing Director at BlackRock as part of their multi-asset strategies group. And also with him is Raamish Saeed, the Model Portfolio Specialist, also in the same multi-asset group. They're going to present a look back on 2022, which was a very unusual year. And after giving Matt and Raamish the opportunity to share their opening remarks, we want to turn this into a conversation. We want all of our participants to have a chance to ask questions or bring up key areas of concern and get those addressed. Two ways we can do that. Folks can either raise their hand and we'll give you the floor, or if you want to add something into the comments box, we will just go from there. And so without further ado, we do try to keep these on time to respect everyone's time. So Raamish, if you'd like to lead us off, that'd be wonderful.
Perfect. David, Kyle, Lindsay, thank you so much for having Matt and I on today's call. And to all the participants, please, we like talking is always nice, but it's much nicer answering questions. So please feel, if you have anything that comes to mind, feel free to use that chat box, get yourself off mute, and feel free to ask Matt and myself a question here. But really, let's talk about where the market has been, kind of all these different scenarios that we're currently navigating. So let's see, last year, for the investment landscape, it was essentially unprecedented. And a lot of investors don't realize this, but what we experienced in 2022 was literally the worst year for the bond market that we've ever experienced. And same thing with stocks as well. It's so rare for both stocks and bonds to be negative at the same time. And last year was a negative. It was the worst year for the bond market and also one of the worst years for the stock market as well. So if we take a look at this chart, you'll see, if we take a look at the first 3 quarters of the year, the bond market was down 14.6%. And if we take a look at the second worst year, it's not even close. It's 3.9%, just to kind of put into perspective, all the significant drawdowns that we experienced in fixed income last year. And similarly to the stock market, the year ended right around 18.11, but by the end of Q3, the market was down around 23.9%. And coming down, there was really, in 2022, there's always going to be value in the market. There's always going to be certain winners and losers, but last year, there was really nowhere to hide. If we take a look at all the different sectors, all the different asset classes that we have, last year, 105 out of 112 asset classes lost money. That coupled with volatility made it one of the most difficult investment years. Just from a pure volatility standpoint, when we had the COVID sell-off in 2020, there were 44 days in the market when the market was up or down 2% in a single day. If we talk about volatility, if we talk about different headwinds that we face in the market, it's not a good investment experience, right? So in the year 2020, when we had the COVID sell-off, there were 44 days where the market was either up or down 2%. In 2022, we beat 2020. There were 45 days when that we experienced extreme volatility in the market compared to just 7 in 2021. So, we were navigating a lot of different things: recession, inflation, different geopolitical tensions. And what did that mean for asset classes across the board? Well, if we just kind of put the market into perspective, some of these drawdowns can seem very difficult when you're living through them. But if we put the market in perspective and look at a chart like this, we can see that, more times than not, the market historically over the last 100 years does trend upwards, right? So we're right here, December, where the market has been down around 24%. But if we look at the upside, there are large periods when the market's been up, 900%, 800%, 500% here. And if we take a look at these recessionary periods, tech bubble, the market was down 44%. The global financial crisis market was down 50%. If we think about how we felt in those times, it just seems like, you're really going through it. But if we zoom out and take a look at full market cycles, and if we continue to deliver market exposure, there are still positive outcomes to experience historically over the last 100 years when we're investing. And secondly, this is the S&P 500. This is the stock market. Let's put the bond market in perspective here. Let me take a look at slide number 7, and you'll notice that we just experienced one of the worst years for the bond market. But if we zoom out and take a look at kind of how bond returns have really been, they average around 5% return if we account for full market cycles. So really, last year we're right here, a bear year where the bond market was down more than 10%. The only year that's ever happened was in 2022. But if we look at these other years where we lost money 0 to 10%, we've had some of those times 0 to 3%. It's been here, but then average return has been 3 to 7. Look at all these different annual years where the bond market has been positive, better than average, greater year. And really right now where we see, rates are coming back, we're able to finally generate some meaningful income. When rates are high, it's kind of difficult to lose money in the bond market. So we'll see how 2023 ends out for the bond market, but it's been, usually when rates are high, it's been pretty positive. So in general, over full market cycles, historically speaking, the bond market, it may seem difficult based on what we just experienced in 2022, but the average return across full market cycles is right around 5%. So that's just kind of setting the landscape of where we've been. But let's talk about, what our outlook is for 2023. And really to do that, let me turn it over to Matt Estes. As David stated, Matt is a managing director here at BlackRock. He represents our global macro strategies across pensions, endowments, sovereign funds around the world. Every time Matt joins one of our calls, I think that he's in a different city and an airport. I think right now he just flew into Dallas. And I've heard Matt speak on several of our internal town halls, and he is one of the more informative, easier to understand strategists that I've ever heard. So Matt, thank you for joining us today, and let me turn it over to you.
Yeah, thank you, Raamish, and David, Lindsay, Kyle, Candace, and for everyone that's dialed in. Great to be with you here today. Raamish, I won't try to pile on too heavily with some of the statistics you already shared, but one thing that, in terms of like being a little bit rearward looking, I love some of the statistics you shared, but I think, if you look at calendar year performance of the S&P 500 going all the way back to 1945, so call it a post-World War II environment, the S&P 500 has had positive annual price return 70% of the time, okay? And if we look at periods when we do have a downturn and we look at the subsequent year, right? So kind of thinking about 2022, where we were down like 20% on the S&P 500, it leaves us asking ourselves, are we up for another down year again? And what I would tell you is historically, right, the average return on the S&P 500 following a down year is about 9.5%. Okay, so it's about in line with average. Now, that's not a prediction from me saying that we're definitively going to generate close to a 10% return, but my point is it tends to be very rare, right? It tends to be very unusual where you have 2 negative calendar years in a row. And what I would tell you is there are 2 fundamental things that are typically occurring in the marketplace when you see 2 down calendar years back to back. Those 2 things are, number one, extreme valuations. What do I mean by that? I mean a stock market that is very, very expensive, okay? For those of us that have been investors for a period of time, you might remember during the dot-com bubble from 2000 to 2002, that's a period where I would have characterized that as a period of extreme valuations, okay? The second driver of kind of negative returns back to back tends to be structurally high inflation like we experienced in the 1970s. So the good news for everyone that's dialed in today, number one, markets are typically positive. Number two, I don't believe that we are going to be in an environment where valuations are particularly or excessively high. And I would say already, I think valuations are probably okay. I wouldn't say they're a screaming buy, but they're not certainly excessively expensive. And number two, and we'll talk a little bit about inflation expectations, I don't think we're going to remain in an environment where inflation is going to remain persistently high. So key takeaway number one, we do recognize that kind of the pace of economic growth is decelerating, right? Meaning economic activity is slowing. I don't think, however, that we are going to go into a long or protracted or deep recession. Again, that is not our base case scenario. Yeah, it's possible we do experience a mild recession, but again, I don't think we're going into an environment like we experienced back in 2008 or during the dot-com bubble. Now, why do I say that? Why don't I back that up a little bit? Number one, we still have a very strong labor market here in the United States. There's been a lot of attention more recently around companies like Goldman Sachs laying people off, Meta, right? You pick Amazon, whichever company has been in the popular press. However, if you look at a metric that's available widely, which is called initial jobless claims or ongoing jobless claims, this is basically tracking people who are either falling out of the workforce or have been out of the workforce. And what I want you to take away from this is those numbers are still at very, very low levels relative to history. So yes, they've ticked higher, but they're coming off an incredibly low level. The second thing that I would make about the consumer, second point I would make, is that the US consumer is in much better financial shape today than what we experienced during the 2008 financial crisis. Okay, if we look at things like household debt to income levels, okay, I realize everyone that's dialed in may not track these statistics like I do, but household debt to income levels back in the 2008 financial crisis, just to put some context around this, it was around 13%, okay? During the pandemic, when everyone received their stimulus checks, that household debt to income level was closer to about 8%, okay? Today, we're sitting around 9.7, all right? 9.7 is almost exactly where we were before all this COVID nonsense began. So again, what I'm trying to tell you is the consumer is generally, has a pretty clean or pretty strong balance sheet relative to history, and we still have a very strong labor market. Now, part of the challenge right now is the Fed is adamant in terms of bringing down inflation. Now, for everyone that's dialed in, I'm sure we all remember what really drove up inflation initially, particularly here in the United States, was you had supply chain bottlenecks. Goods could not be produced because employees were sent home. Manufacturing floors shut down. All of us, well, particularly I can speak for myself, who lived in the Northeast, we were barely allowed to leave our homes. So what did people do? They bought goods. So there was a shortage of goods available. Now what we've seen is those supply chains have largely, unfrozen. The inventory levels have been replenished. And now you're seeing a lot of that pressure coming off the goods side of the equation. Here, however, lies the dilemma. The challenge is, and where we're seeing most of the inflationary pressure today, is on what I call the services side. And what I'm talking about are those are actual, jobs where people are performing a particular service. And where we've seen a lot of job creation in recent months has been in areas where, quite frankly, there is a significant need for more labor, okay? And here I'm talking about areas like education, like healthcare. Those were areas where we saw many employees drop out of the labor force. We're probably still short about 800,000 workers across those two cohorts. Again, I'm talking about healthcare and largely education. So what I'm trying to tell you is the challenge the Fed has is they're trying to push down inflation. How do they push down inflation? They're trying to push down labor rates. But the problem is where a lot of, you're seeing inflationary pressures are in some of these areas where workers are needed. So I think the risk to the broader economy is that the Fed remains overly aggressive, right? They try too hard to bring down this inflation. And inadvertently, what they may end up doing is putting pressure on what I would call interest rate sensitive areas of the economy. And what I'm more pointedly referring to here is areas like housing and think autos. Okay, so if you looked at the auto market last year, and even if we stripped out companies like Tesla, where I think there were a lot of idiosyncratic issues, the auto sector was down about 40% last year. Okay, the S&P 500 was only down 20, autos were down 40. If you've been following what's been taking place in housing markets, you've certainly seen a slowing in housing as well. Now, I don't think we're going to see an imminent collapse in housing prices. There's an argument to be made that says we're structurally short about 5 million homes in the U.S., but that pace of acceleration in home prices that we've been seeing for many quarters and over a couple of years, I think that begins to abate. So again, our base case is that inflation does come down over the course of 2023. There's a number of different ways to measure inflation. I won't go through all of them. The Fed has their own preferred measure. It's called PCE. Let's just focus on core CPI. I think that's a metric that probably more of us are familiar with. Today, core CPI is around 6%. Our estimation is that it probably comes down closer to about 4% by mid-June. So the good news is we do think that inflation is coming down. It's still higher than what we had experienced for the better part of the last 20 years, but it is trending in the right direction. So for the Fed, I think that this means they raise rates, and I think that a term we like to use is what's called the Fed funds terminal rate, meaning how high will they raise rates to? I think they probably get to a level of about 5%, okay? Maybe it's 5.25, maybe it's 5.5, but our base case says that's probably a number of around 5%, which means we're probably talking about a rate hike of maybe 25 basis points, maybe another 15, maybe 25, but not these persistent 75 basis point hikes like we saw last year. So what does this mean for kind of markets and investing? It means in the short term, I think we're still probably going to experience a little bit of, kind of more volatility in the markets. I would tell you, we're being a little bit patient before we kind of rush in and what I would call back up the truck to kind of move money into equities. I would say we're kind of more neutrally postured in terms of that equity allocation. I think once we see signs that inflation is coming down on a fairly sustained basis, the Fed takes a pause from raising rates. At that point, we'd be a bit more comfortable, leaning more heavily into equities. The other thing I would say is I think we could be in an environment where in kind of the short, kind of immediate, sort of time frame, we're a little uncertain how some companies are going to adapt to this slower economic environment. Right, there are some companies that are going to struggle. So what we would generally advocate is you want to favor what I would call companies that exhibit what I call this quality bias. And what do I mean by a quality bias? I mean companies that are not heavily in debt. They're not heavily levered, okay? Companies that can continue to grow their free cash flows in a low growth environment. The other thing I would say is you've seen certain areas of the market, what I would call secular growth areas, in particular areas like technology. Some of those areas have been hit really hard in the face of higher interest rates. So the other theme that we really like is this exposure around what I call GARP. And what that simply means, I know it's a lot of acronyms here, growth at a reasonable price. It means owning some of these technology companies, not the quote unquote startup or the high flyers, the companies that won't be profitable for 10 or 15 years, those types of companies will struggle. But there are plenty of companies in the technology sector today that are profitable. And then lastly, I think that there is likely to continue to be some pressure on some of what I call the resource areas in the market. And here I'm talking about areas like energy and parts of food production. So we do like to have some of that, what I call almost indirect exposure to commodities, by owning some of the companies that are responsible for the production or transportation of some of those commodities. Couple last points just on fixed income. For many years, there was a narrative in the marketplace that said, gosh, there's no yield to be generated in fixed income. Well, part of the benefit of the Fed raising rates is you can finally generate some pretty attractive levels of income in areas like corporate bonds, both investment grade and maybe even holding a little bit of high yield, depending on your risk spectrum. Lastly, I do get a lot of questions about our views on the US dollar. The US dollar went through a period of significant price appreciation relative to some of the other world's major currencies. Largely, that was a function of the Fed that was raising rates more aggressively than, say, the ECB, the European Central Bank, the Bank of England, or the Bank of Japan. But at some point, when the Fed gets to a level where they pause and other central banks are behind them in terms of that rate rising, we anticipate that the dollar will no longer continue to appreciate like it had been. And it's possible we may even move into an environment where the dollar starts to weaken. I will add, typically in environments where the dollar is weakening, like I've just framed up, that historically has been an advantageous time to hold some assets or some securities, hold some stocks outside of the United States. So again, just really quickly, I think economic activity is decelerating. We're not moving into a deep recession, still have a strong consumer, still have a fairly strong corporate sector as well. I think the Fed raises rates to a level of around 5%. That will cause a slowing in the economy, but not kind of an outright derailment. So I know I've thrown a lot out there. Why don't I check in and see where there's questions? Happy to start with a team or open it up directly to some of our clients that are dialed in.
All right, so any of y'all have questions? I mean, this is where I geek out, so I don't want to dominate with questions because I get an opportunity to speak to an economist here, and that's wherever, I start asking all my questions. So, stop me if y'all have any other questions. But so right now, what we're looking at is the Feds came out, last week? All the weeks kind of blur in together and say, hey, no interest rate rises in 2023. But if we take this and we go back a few years, what was that, about 2 years ago, the Fed said that we're not going to raise interest rates for the next 4 years. Happened back in 2020? Okay, they made those bold statements, and investors sit here and go, oh, well, the Feds aren't going to raise interest rates, and here we are. Okay, the writing was on the wall. Do we take them for what they're worth, saying, hey, we're not raising interest rates this year? Are they going to have to?
So, I think it's still, look, there's certainly a non-zero chance that the Fed continues to raise rates. And I think, our base case says, you probably get another rate or two, another, 25 basis point hike or two. I don't think that continues. I don't want to say for perpetuity, but I don't think that continues for an extended period of time, Kyle. And the reason why I say that is a couple fold. If you start to raise rates too high, you start to really have some significant impacts to the broader economy. If you look at the housing market here in the United States, there's about 2.4 million people that are directly tied to housing, right? Housing construction, builders. But if you look at the second derivative of that, you look at attorneys, lawyers, that has a multiplier effect of about 9x. It's closer like 21 or 20 people to 20 million people. So if you really derail the housing market by ratcheting rates up, super high, that can have some unintended effects that are difficult to reverse. The other thing I would say too is that if you begin to raise rates so high, right, it almost acts as like a tax on the consumer, and it really impedes you from a fiscal standpoint to implement any policy objectives that you may want to enact. Said otherwise, it gets hard to enact programs around, say, taxation if you're basically pulling all the money out of the system by raising interest rates. So there is a level at what point, it becomes more damaging to the overall economy than I think even the Fed would like to entail. So again, that's why our base case is around 5 to maybe 5.25 on the Fed funds terminal rate. Again, I think the Fed does recognize there is a lagged effect from these rate hikes. And once we get to that kind of 5-ish level, we think they take a pause and kind of let some of that data digest.
All right. So kind of switching gears here because, when you're talking about we are talking about the 105 sectors, that went down. Well, I know one sector that went up, and that's kind of like hot on the individual investor side, is pharmaceuticals, because they're seeing all this push on vaccines and new drugs and everything. You spoke on technology, which I completely agree. I love technology. What are we seeing in the pharmaceutical market? Are we going to see, hey, they had a great ride, or are we going to see it calm down?
No, we do like some of the pharmaceutical names. Again, they kind of go back to that comment that I shared around quality exposure, companies that can kind of grow their free cash flows in a low growth environment. And they're also the beneficiaries of, what I would just call an aging demographic trend that we have throughout much of the developed world and even some parts of the emerging markets. I wouldn't limit it to just pharmaceutical, although that's one area of healthcare that we do like. I would also throw in some of the managed care providers in that boat as well. And I would also tell you, we even like some of the medical device manufacturers also. So yes, healthcare is definitely an area that we like alongside of some of that tech exposure.
All right. Well, I don't want to dominate. So what other questions can y'all think of?
Yeah. I'd be glad to jump in. Matt, could you, I'm going to ask you to predict the future. This year, as the Federal Reserve starts to raise rates, you shared that they're closer to the top than where we got started a year or so ago. Every time there's good news in the marketplace, it seems like there's volatility to the downside in stock market and vice versa. So we've had a lot of volatility. Raamish shared all those number of 2% days. I saw a different stat on last year where 122 of the trading days, which is about half the trading days, had 1% moves. Is this year going to look like last year with that volatility as the Federal Reserve tries to find a balance?
Yeah, okay, so this is a great question. I'll try to be succinct. So first thing I would share, when I shared those statistics about when you had down years and the subsequent year being a 9.5% average annualized return, what I would also share with you, historically, the volatility of the S&P 500 long-term is around 10%, okay? When you look at those years after a down year, right, that average of 9.5%, the challenge there is your volatility profile tends to be a lot higher. So the first thing I would say is, yes, historically after a sell-off, markets historically have been positive, but they're also associated with higher levels of volatility. And that's typically because there's just a bit more uncertainty in the marketplace. The other thing I would say is that for the better part of 15 years, David, we've been in an environment where whenever central bankers started getting nervous, market participants actually got happy because they knew that central bankers were coming in and they were applying what they called the Fed put, right? They were providing some kind of accommodation in the forms of monetary policy that basically lifted markets. And the one thing about providing liquidity, or when they do these quantitative easing type programs that we experience in the US and Europe and Japan, when you push out a lot of money into the economy, it has a dampening effect on volatility. So it tends to mitigate, it tends to mute volatility. So what I would say is, I don't want people to be unnecessarily nervous about volatility. But I guess what I would say is, we're probably moving back into an environment where volatility is higher than what we've generally experienced for the past, call it 10 or 15 years. So again, I'm not saying we have another 20% down year, but it's an environment where things are a bit more volatile. The last thing I would say on the fundamental side is, we have some heightened geopolitical risks that exist around the world today. There was a long stretch of time where we had the period of great moderation where you didn't have those sort of geopolitical headwinds. You know, the tensions between US and China, that's not going away anytime soon. You know, China generally feels like the world order that was established post-World War II, they didn't have a seat at the table during that. And so, you know, I think that the period of peak globalism is largely behind us. That entails supply chains that are being redrawn. Again, all of this translates into a little bit more of a less certain economic environment and probably something that is a little bit more volatile. Again, not to say that we have a down year like we had last year, but it's not as smooth as what we've largely come accustomed to.
And
Okay.
Matt,
Yeah.
if I could do some friendly fire, I hope you're okay to go over a couple minutes because I'd like to ask you a question as well. So the team that you work on, Matt, you guys run the GA Select strategy. One of the portfolio managers is Rick Reeder, BlackRock's Chief Investment Officer of Global Fixed Income, and he's talked about how right now where rates are, it essentially presents us with a multi-year opportunity to lock in yields, to lock in return. So how's your team right now looking at the fixed income space, looking at different fixed income sectors to lock in that multi-year opportunity that we haven't seen in decades?
Yeah. So for all you who are down in Texas, like to go up to Denver and ski, the analogy Rick used the other day was, you know, rising rates are sort of like taking the chairlift up the mountain. And so, you know, the further the Fed goes in terms of hiking rates, the more enjoyable the ride is on the way down. So again, I don't think we're totally at the top yet, but we're pretty close. I'd say we're 95% of the way there. And then, you know, I think we're in an environment then where you can hold some high quality corporate bonds that don't necessarily have to be very long dated or have what I would call a long maturity. You can generate attractive levels of income with shorter duration bonds. Again, I would generally lean more in favor of higher quality bonds, but those are actually generating, you know, you can find a 6% yield on, you know, a high quality corporate bond, you know, 3 years and shorter. So those have that's certainly been the asset class that I would say we've been most constructive on for 2023 and maybe even for a year or two longer. I think eventually we go back to an environment where we see the yield on the 10-year treasury return to 2 to 3%.
Any other questions from anybody before we finish up? Well, Matt and Raamish, I thank y'all so much. I really appreciate your time. It was very, very informative and very timely as we're starting off 2023. We are going to have this recorded and sent out so that way everyone can kind of look back at it if you had any extra questions or maybe just missed a couple points. Our next Tuesday talk is going to be on Valentine's Day on February 14th. And we are going to have Heather Garza, who's one of our colleagues. She's a CPA, and we're going to be talking about just new tax laws for 2023 before you're filing your tax returns this year. So we're looking forward to that. And we just thank you all so much for joining us. And we look forward to talking to you soon. Thank you so much, Matt and Raamish.
Our pleasure. Thank you.